Good afternoon and welcome to the ASEAN Midday Market Watch. Our guest today is David Kuo, founder of the Smart Investor in Singapore. David, great to have you on the show this Monday afternoon.
Yeah, Selamat Tanggahari, Brian. How are you?
Yeah, good, thank you. Now, before we get your insights, let's take a look at how the markets in the region are performing because it is a sea of green across the region. We'll start close to home with the SGX. It's at 1,599.95. That's the only market bucking the trend. It's down 0.52%. Bursa Malaysia, it's at 3,209.15. It is up 0.25%. Now, across the region, let's take a look and we'll start with the Nikkei. The Nikkei is at, just give me a second. It is at 29,734.85. It's up 0.17%. Shanghai Composite is at 3,471.17. It's up 1.3%. The Hang Seng is up 0.8% at 29,201.88. The ASX 200 is at 7,077.10. It's up 0.19%. And the Kospi rounds up the numbers at 3,210.70, which is up 0.38%. Now, what's your view on why markets are performing so well, David?
I think, Brian, they're playing a bit of follow the leader. So we had on Friday night the Dow closing up about 160 points, which is about 0.5% higher. So what is happening in Asia now is that they're just doing a bit of Simon Says. Simon says the market goes up, so Asia goes up. But I think apart from that, Brian, I mean, I'm being a bit facetious. I think people are a little bit more confident about the global economy improving. The economic data seems to suggest that things are getting a lot better. And so people are looking at the possibility of many of the companies that are listed on the stock market generating better revenues, better profits. And if that were to happen, then I think the stock market has some way to go yet.
And I'm going to come back to you on that in terms of the stock market and something that you wrote about yesterday. But taking a cue from what you just said about good numbers, this morning's announcement of Japanese export numbers in March, which surged 16.1% compared to a year earlier, much higher than the 11.6% that economists in a Reuters poll had suggested. Now, this is another positive export number. We had good numbers out of China. We had good numbers out of Singapore last week, basically all reinforcing this whole global recovery narrative. But do you subscribe to this, especially when you see that, you know, David, the numbers are great, but they're actually from very low baselines from last year. Yeah. So what's your view on this?
Well, you are right to be skeptical. I mean, when you compare it to what it was this time last year, everything is going to look good. So you are right up to a point. But let's not forget, Brian, that people don't export in a vacuum, right? Where there are exporters, there must also be importers. In other words, there are economies out there that are buying these goods. And in the case of Japan, I mean, they make capital goods. In other words, they make machinery. Oh, obviously, they also make cars and things, but they make predominantly machinery. So when you have a look at the countries that are importing from Japan at the moment, then you've got countries like China, Thailand, Taiwan, Singapore. I mean, these are countries that are buying machinery from Japan. Things like semiconductor machinery, plastic manufacturing machinery. So they're buying these goods. So I think what it is suggesting is that manufacturers around the world are feeling a bit more confident. They can see that there is a future, whereas this time last year, they could not see anything at all. It was almost as though they were in a haze. So I think it is quite encouraging, but you are absolutely right. We are comparing with what it was in 2020, and 2020 was a year that everyone wants to forget. So looking forward, I think I can see some good signs there, Brian.
Now, in your article yesterday, Smart Thought of the Week, you talked about interesting parallels between the roaring 20s and the current stock market. Could you give us some brief insights and some key takeaways?
Okay, let me say, first of all, I wasn't around in the roaring 20s, right? I may have gray hair, but I was certainly not born in the roaring 20s. But history tells us that the roaring 20s happened after World War I. And World War One lasted around 4 years. And during that 4 years, there was total destruction of the global economy. Nobody did anything apart from fighting wars. Now, the pandemic was only 1 year rather than 4 years for the World War One. But there are interesting parallels between the two. We have a lot of pent-up demand at the moment, and that pent-up demand is being unleashed. You and I were talking before the interview today that you were able to go to a fishing village somewhere. That is pent-up demand. And there is a huge amount of that pent-up demand. And some people are saying that, what happens when this pent-up demand is unleashed? Are we going to be getting what we had in the roaring 20s? In other words, 10 years, almost 10 years of unrestrained stock market exuberance. And during that 10 years, the rate at which stocks were rising was about 20% a year. So whatever you bought at the beginning of the 1920s increased sixfold by the end of that 1920s. And then what happened, we all know, in 1929, we had a stock market crash, right?
Yes.
Stocks came down with a bump. And after the stock market crash, we had the Great Depression. So some people are saying, are there parallels between what is happening now with what happened in the 1920s? I mean, we can see unrestrained growth at the moment as far as the stock market is concerned. The Dow just keeps on hitting record highs day after day, week after week. And people are saying, are we seeing that exuberance being played out in the stock market?
Yeah.
To some extent, yes, right? But we have to compare what is happening today with what is happening in 1920. In 1920, we had never even heard of the term quantitative easing, right? Yes. Quantitative easing back in the 1920s was something you probably took for severe constipation, right? And it gave you quantitative easing. But today, central bankers know how to handle it. So they can see there is asset price inflation. They can see the stock market at rising at phenomenal rates, but they also know how to handle it, Brian. They have this technique called quantitative easing, which is able to, if anything were to happen to the stock market, wheel out that printing machine again, press the button, and they will just produce more cash. But people need to be aware that in the 1920s, nobody had even heard of the price to earnings ratio, whereas today we have. And so we have some way of measuring whether or not the stock market is expensive. And some people might say PE of 30 is expensive. And I say to them, compare the PE ratio of 30 with what, right? With interest rates. Interest rates are virtually nothing. So the PE ratio is not expensive compared to interest rates. So we need to watch interest rates very carefully, Brian. If interest rates start to rise, then we have to compare that with a PE ratio and say, is it getting too expensive? But for the moment, not really.
David, as always, thank you very much for your insights.
You're welcome. Thank you.
Now, we've been speaking to David Kuo, founder of the Smarter Investor in Singapore, on BizTech's ASEAN Midday Market Watch. I'm Brian Fernandez. Check out www.biztech.asia for business and technology conversations. Please subscribe and like our Facebook and LinkedIn pages as well.